Dan Frio here, the Mortgage Update. Today is March 17th, 2020. Well, the Fed's at it again. They're going to pump in about $1 trillion in stimulus. That's been great for stocks. I think the stock market was up over 1,000 points today. What did it do to mortgage rates? Well, let's find out. So, we'll go over the mortgage-backed securities market. Those who follow me, thank you for coming back. Let me kind of do a quick explanation on who I am and why do we follow this number that we're going to look at right here. My name is Dan Frio. I do the Mortgage Update every night. I'm a mortgage advisor in the Chicagoland area. Have been doing it for 32 years. If you're in Chicago, tune in tonight, Monday through Friday at 7:30 to 8 o'clock on WYLL radio. If you're Saturday mornings, you can find me on WIND radio. It's one of the largest radio stations in Chicago. Saturday mornings from 7 to 8 a.m. So what we do is we follow the mortgage-backed securities market because I want to know, or I want to be your mortgage advisor to explain to you where rates going. And what I try to do is figure out where are they going, why are they going to be there, and how do we position ourselves in a position to get the best rates for you. Everybody says we have the lowest rates and the lowest fees and all this other stuff. Do they really? Do they know what's going on? Do they know, if you wait 10 minutes, rates might go down? Probably 99% of the people out there don't. They don't have a clue. Call them up and say, what are rates going to do tomorrow? But I don't know. They've been going down. That's not the right answer. The 10-year Treasury was up today, so yeah, rates are probably going to go up tomorrow. That's the wrong answer. I can say, mortgage-backed securities are down 22. However, the trends we have and what the stimulus packages are doing, here's what I think is going to happen tomorrow. Am I right all the time? No. But I picked it last Monday. I picked a bottom and locked in $16 million worth of clients. Okay? The average rate was 2.875 on a 30-year fixed. Yes, 2.875 on a 30-year fixed. No, we didn't charge 3, 4, 5, 6, 7, 8,000 in fees. That was no points. No points. So 2.875 with no points. By the end of the week, rates were about 3.75. What's the difference in the payment on that? Let's just do this before I go anywhere else. Let's do an amortization schedule real quick and see. On my clients, we average loans $300,000. We did right now. Rates are about 3.75 on a 30-year fixed. Yes, that's where they are. So the payment would be $1,389. Okay. I locked this person in last week at 2.875. What's the difference in the payment? $1,244. Okay, well, let's look at this. How much would this cost them over the term of the loan? At the 2.875, they're going to pay $148,000 in interest. Kind of makes you want to throw up, but that's just the cost of doing business when you're, getting money. That's what I got most of these clients. But let's say just the rates went up to 3.5 because that's where they were last Thursday, 3.5. So we got 148,000 here. Where's it go to? 184. That's almost $40,000 in interest. 40,000 in interest that I saved a lot of people. Okay, that's why we watch this number here. Let me explain to you what this is. This is a bond that trades and creates, or the tool that dictates mortgage rates. Okay, as this rate or this number goes down, this is the price of a bond. As the price goes down, the yield goes up, meaning you're paying less for that investment, so you're getting a higher rate of return. We hate that because we're not getting that return. We're actually getting a mortgage for that, so we're paying that back. So we have a higher mortgage rate. Okay, so we love when this number goes up, such as it did in the last quarter. Right here, I saw the mortgage-backed securities market opened up 80, dropped back down to right where we opened the day, and then actually dropped negative. When I saw this immediate drop, you can see it's just one stick right there. That's one trade. I yelled out to my whole staff, lock everything we have. And since then, again, we went from 2.875 to last Thursday, we were about 3.75, between 3.75 and 4%. Okay? So just think if you're at 4%, we probably saved you about $80,000 in interest. Okay, so what happened during this time after that? Well, the Fed stepped in on Sunday and said, you know what, we're going to do a lot of things to curtail this market. So since then, we've been able to come back up and get mortgage rates in the mid threes now. Not the 2.875 that we got right here. But I monitor this. So let's walk through what happened today. The market opened up. Mortgage-backed securities were down 3. All right. And I'm really not going to look at economic figures because you know manufacturing is terrible. You know employment's going to be bad because they're shutting down a whole bunch of companies. You know there's going to be no inflation because there's really no products being sold. Let's throw everything out the window right now and say, what's going to go on with mortgage rates? Basically, the only determinant of this thing is what's the government doing about it? And I hate to say it, I'm not a person that relies on the government to make my living or my backstop. But in a case like this, that's all we have at this point. So the government stepped in today and said, you know what, we're going to pump in about $1 trillion in stimulus. And a big piece of this is they're coming in and buying up mortgage-backed securities. They're going to use $200 billion plus to start buying mortgage-backed securities. So that's higher demand for the product, mortgage-backed securities. The higher the demand, and you have ample, just a minimum supply, that drives up the price. That was the goal. And that's what they did on Sunday, and it jacked everything back up to here. Okay, so now we see today it went down 22. Well, there's a couple things involved in the background of things. Right now, let's kind of throw this out the window. Generically, if you looked at this chart or you gave me this chart, I would say, today's rate should be about 3.25. Well, they're about 3.5. Why are they higher than where they should be? A couple things. I found a great article to explain this. We aren't I won't say we. Most lenders aren't staffed to handle this amount of volume. Basically, if you have a mortgage right now, you should be refinancing. I don't care if you want to reduce the term, reduce your payments, do whatever you want. Rates have never been this low. So whatever rate you have, the rate that's out there today is lower, period. Unless you have an adjustable rate or you have a loan that was taken out at some time or you have, you've got a modified loan or something. That's the only reason why you would have a lower rate than where they are today. So most lenders, or a lot of lenders right now, are not locking in the rate. They might not even be taking your application. And if they do, they're probably saying, it's going to be 3, 4, 5 months before we can close your loan. I'm not saying that. I can still close you within 30 to 45 days. I can lock in your loans and we can handle the business. I've staffed up for this. Okay, so that's number one. One of the biggest things that's hindering the business is when you lock in, you call me and you say, Dan, I want to lock in my rate. I say, okay, let's lock it in. Well, what happens is we have to go into the market and pull that amount of money out and hedge it because we know we're closing a $300,000 loan in the next 30 days on that particular person. So we have to pull down that money and hedge it. We got to grab that money at that particular interest rate. Well, with the volatility from minute to minute of this big of volatility, we have to pay more for that hedge than we normally have to pay because minute by minute, nobody really knows what's going on. So there's a bigger cost factor there for us. And then this is also a way for lenders to say, it's basically you turn on the spigot. If you want to turn on the spigot, meaning you want to drive in more business, you lower your rates. If you're saying, you know what, we have more than we can handle right now, we just want to get through these and make our customers happy, we turn up the rates so not as many people are coming to us now for mortgages. So it's right now, rates are going to vary hugely by lenders to see if they want the business or not, okay? Right now, we're handling the business, and I just got an estimate in today for, I won't share the person's name, but it was a $353,000 loan. They were on a 30-year fixed. They got 3.75 from their lender, and that lender was charging them $3,630 in fees plus another $2,900. So we got $6,500 in costs. Mine was 3.75, so I got them a rate of 3.75 lower. My costs were a total, I saved this person $2,735 in costs. So not only did I give them a rate 3.75 lower, I saved them almost $3,000 in costs. So this lender, either that's their cost structure, they don't want the business right now. So even if you're looking for a mortgage now, send me your loan estimate. Let me look at it. In almost every case, we're beating it right now, and I'm getting them closed in time. So that's what's going on with the markets right now. So what does the future bear? Well, I think that's going to we're going to start stagnating a little bit. The Fed jumped in, and they're going to pump liquidity into the markets, meaning they're going to start buying mortgage-backed securities to kind of put a stability in the system. This is a normal week right here. Not this. In putting in perspective, the stock market doesn't usually change 1,000 points a day. 1,000 to 2,000 points a day is very rare ever in history, and we're seeing it every day now. The same thing is happening with mortgage-backed securities because nobody really knows what's going on, but nobody likes to say that. So if you talk to a stock analyst, oh, here's what's going on. They don't have that. Honestly, they don't know what's going on. We don't know what tomorrow's going to bring. I just want to be honest with you. So what are rates going to do tomorrow? I don't really know, but I know just because of the hedging factor, because it's so volatile, rates should be probably about 1/4 to 0.5% lower than they are. So as long as things just stay stable, I'm not locking anybody right now because I'm waiting for the volatility to kind of smooth down. And then at that time, I'm going to lock people in. It's probably going to be about 0.5% lower in rate now. So if you're calling me now, I'm probably not going to lock you in. I'm going to say, you know what, here's where I can get you today. But hang on, I monitor this close enough that I'll at least tell you, I'll get you that rate. But my goal is to get you lower than that. And I hopefully you'll check out my reviews, check out my comments, check out everything you can on me, and I hope I deliver what I say. So I'm going to end it there. It was long enough. My name is Dan Frio. I do the mortgage update every day. I hope you like what you see. Give it a thumbs up if you like it. Please don't forget to subscribe down below. If you'd like to work with me or at least reach out, give me a call at 844-775-LOAN. That's 844-775-5626. You can reach me at my email address is Danny, DANNY, .Frio, which is FRIO, at preferredrate.com, or just look me up on Google. Just look up the mortgage update with Dan Frio. You'll find about 6-7 pages for me. If you YouTube now, just mortgage, I'm coming up on the first page. Thanks to you guys. So God bless. Thanks a lot for watching. Don't forget to give me a thumbs up. Put a comment down below what you want me to cover, if anything. And I guarantee I'll respond back to you. If you go back through all my YouTube videos, I answer every question and every comment that's listed below. If it's not a question and you're just saying, hey, great job, guy, and keep it up, I'll give it a thumbs up. So God bless. See you tomorrow, same time, same place.